All right, let's cut right to it. The era of the human trader is over. It's dead. What we're witnessing is a massive shift where autonomous AI agents are taking over DeFi, while Wall Street algorithms are literally front-running the US Congress to buy the physical AI grid. Today, we're mapping out these new rules of money.
Now, standard disclaimer, everything you're about to see is for educational purposes. This is absolutely not financial advice. Every single investment carries a risk of loss, so do your own research.
And this quote right here, it nails it. This isn't just about faster trading. We are talking about a definitive, historical transition, a fundamental handover from human-run systems to machine-operated sovereign economies. It's a profound concept, so let's dig in. At the very center of this new paradigm is the rise of what we call agents. And no, not secret agents. These are autonomous entities about to completely rewire the world of finance. This is Agentic Finance, or Agent Fi. And look, let's be clear. This is not just a new skin on the old rule-based quant algorithms you're used to. Those were simple if-then bots. These new agents, they can reason, they can strategize, they can operate entirely on their own, managing their own crypto wallets. They are, for all intents and purposes, sovereign financial entities. So what's the real delta here? Well, a human trader, even the best one, is limited. You have cognitive load, you need to sleep. An agentic trader? It operates 24/7. It can synthesize SEC filings, global news sentiment, and real-time capital flows in milliseconds, and execute without hesitation. The gap in capability isn't just an edge, it's an evolutionary leap. So how are these agents getting their alpha? Well, one of the most powerful ways is by mining a completely unique source of alternative data, coming straight out of Washington, D.C. They're leveraging what's called alternative data. And in this very specific, very powerful context, that means programmatic scraping of the official disclosures that members of Congress are required to file. They're not looking for news, they're looking for signal. They're looking for the flow of informed capital. And here's a perfect example of that signal. We see a filing from Nancy Pelosi's household for a $1 to $5 million purchase of call options on Broadcom, ticker AVGO. Why does this matter? Because Broadcom is the physical layer of the AI revolution. An agent sees a multi-million-dollar leveraged bet on core AI infrastructure from a high-profile political insider, and it treats that data point as pure, actionable alpha. In plain English, this means, while retail relies on outdated news, algorithms are instantly tracking congressional filings to front-run massive political trades in AI, semiconductors, while using Bitcoin as a hedge against the collapsing fiat system. But this isn't just about picking one stock. This entire strategy is nested inside a much larger macroeconomic thesis. It connects that DC data not just to AVGO, but to the unavoidable reality of sovereign debt and the algorithmic role of an asset like Bitcoin. Take a look at this number. According to projections, this is where the U.S. national debt is headed by early 2026. This isn't just a number. It is the fundamental backdrop for the entire macro trade. And to put that in perspective, the annual interest payments alone are set to eclipse the entire U.S. defense budget. Think about that. Over $1 trillion a year just to service the debt. This creates a kind of fiscal gravity that's impossible to escape. And that gravity leads directly to a condition called fiscal dominance. It's a situation where the Treasury's need to service its debt effectively forces the central bank's hand. The bank has to subordinate its inflation mandate to help the government manage its massive interest payments, usually by keeping rates artificially low. So what's the endgame here? If you can't raise rates without bankrupting the government, you're left with debasement. And this is precisely where Bitcoin enters the thesis. It's a programmatic, algorithmically scarce asset. Its supply is fixed. It cannot be printed to service debt. For an algorithm, this makes it the logical hedge against sovereign fiscal decay. So you have these two massive forces, AI agents driving productivity and governments drowning in debt. This collision creates what we're calling the agentic squeeze, and it leads to 3 possible outcomes. Now, before we map out the bear and black swan scenarios for this trade, hit subscribe so you don't miss our weekly dark pool audits. Okay, let's look at the futures. So here are the 2 core scenarios. The bull case is simple. AI drives a massive productivity boom, but the debt overhang is so large that central banks are forced to monetize it anyway. The result? AI stocks like Broadcom and a hard asset like Bitcoin go absolutely parabolic. The bear case is a regulatory clampdown. Congress bans stock trading, the SEC goes after autonomous agents, and the entire alternative data edge gets crushed overnight. Then there's the black swan, the real tail risk. Imagine one perfectly crafted AI deepfake news story hits the wire. 100,000 agents ingest it, validate it against each other, and hit the sell button in the same millisecond. We're talking about a multi-billion-dollar liquidity crisis, a flash crash so violent that human circuit breakers can't even react. That is the new systemic risk in a machine-led market. So what's the takeaway? We're in a new information war. The rules have been completely rewritten, and machines are now the dominant players on the battlefield.
So here are the new rules. 1. Your information edge is now measured in milliseconds. 2. Human analysis is being mathematically outcompeted. 3. The market is now an adversarial environment between competing algorithms. 4. This means capital is algorithmically flowing to assets with verifiable, programmatic scarcity. And the most important rule of all, you never, ever fight autonomous, algorithmic capital flow. That means you use ATR-based trailing stops for volatility, you respect the 20-day EMA, and you absolutely reject any setup trading below its 200-day moving average. Defend your capital.
And this leaves us with one final question. In a world that is increasingly run by these autonomous agents, who actually has the ultimate information advantage? The architects of the agents themselves? Or is the very idea of a lasting edge just gone? Let me know your thoughts on AVGO and BTC in the comments below. Like the video and make sure you're subscribed.